A student loan is a type of loan designed to help students pay for post-secondary education and the associated fees such as tuition, books and supplies, and living expenses. There are 3 types of student loans: private loans, federal loans, and refinance loans once you leave school. There are many producers competing to provide consumers with the service of student loans, making this a competitive market. Governments provide federal loans, credit unions, banks, and states make private loans and refinance loans. Federal aid offers direct subsidized and unsubsidized loans. Interest does not accrue while the student is in college for subsidized loans, and it is the opposite for unsubsidized. Since the government controls federal loans, Congress sets the interest rates each year. Just within the past year, the interest rate on federal loans has increased from 4.45% to 5.05% for undergraduate degrees, while the interest rate for graduate and professional programs currently sits at 6.6%. The total amount of student loans reached an all-time high in 2019 at $1.41 trillion. This is a 6% increase from 2018 and a 33% rise since 2014, when total debt was $1.06 trillion. However, the private student loan debt market is just a small amount of the $1.6 trillion in outstanding student loan debt. In both 2018 and 2019, the average interest charged by a private lender was 10.2%.
Federal student loans make an estimated 92% of all loans. Since the majority of student debt is government grants, the Levi Economics Institute of Bard Colleges suggested a plan to cancel all federal student loan debt. The paper suggests that 44 million Americans with student debt have to make monthly payments, and they strip potential money from local economies. This reduces consumer purchasing power. By eliminating student debt, America would experience an increase in GDP by 86 million each year. This increase in economic activity adds 1.2 to 1.5 million jobs and will reduce unemployment. If federal loans are forgiven, the demand for college education will increase, causing national debt to grow. Due to the change in tuition price each year, people have to take out more loans. After adjusting for inflation, the fees and tuition in the U.S. have tripled in the last 30 years. The price elasticity of demand for student loans is too great. Canceling student loan debt would result in price discrimination, which would only benefit the upper 20% of Americans, and the poor would stay in debt because they don't qualify for loans. The government taking on trillions in student loans would cause a budget deficit. It would set a dangerous precedent, and we cannot continue to run an initial $1.4 trillion deficit and then continue to run a deficit each year. Despite arguments from liberal politicians such as Warren and Sanders that it will increase the well-being of the economy, the positive economic effects would only occur in the short run.
To hit the reset button. Under the proposal that we introduced today, all student debt would be canceled in 6 months.
However, the long-term consequence would send the U.S. into spiraling economic debt. Another popular argument is Senator Warren's plan. To solve the issues of student loan debt, she suggests a plan that would cancel student loan debts up to $50,000 for family with incomes below $100,000.
First of all, she would wipe out up to $50,000 in student debt for 42 million Americans, all those with incomes under $100,000. Secondly, she would use money to wipe out tuition at public colleges and universities. Third, she would put a bunch of money into Pell Grants to cover non-tuition expenses. And finally, there's a fund to finance assist in financing historically black colleges. Total cost $1.25 trillion.
Although it seems reasonable at first, 60% of high-income families defined as making more than $114,000 per year take out loans to get a bachelor's degree due to rising tuition. Since the 90s, the percentage of higher-income families doing this has more than doubled. College tuition is increasing rapidly, and higher-income families can no longer afford college. Therefore, as tuition continues to rise, so will the percentage of higher-income families taking out student loans. Our argument is to set up a binding price ceiling for their tuition of $50,000 a year. This will be our method of internalizing externally and incentivizing students to take out less loans. This will cause a shortage of loans to occur, however, less people will now demand loans because the cost of college is decreasing. This would mean that the loan market would make student loans more elastic, and with a binding price ceiling, students will have more affordable college opportunities. This will move the market closer to an equilibrium, allowing anyone who wants to borrow student loans to have the opportunity to borrow.
Although student loans have increased the amount of students able to earn higher education, student loans create negative externalities on ineligible students because they have to pay higher tuition fees. The demand for education of low-income students with high ability would increase because of the loan programs offered. However, this increase in demand pushes the cost up, which affects high-income students in the margin. According to the study of welfare economics, the allocation of student loans would negatively affect economic well-being. According to the National Association of Realtors, 83% of non-homeowners say student loan debt is preventing them from buying a home. Student loans also affect credit scores. From 2016 to 2019, the average applicant FICO credit score for private student loans was 644, while the average approved FICO credit score was 737. The willingness of borrowers to pay for student loans is too high, with borrowers taking out student loans at higher interest rates than they can afford. For instance, the average mortgage interest rate is 3.9% and auto loan interest is 4.2%, while student loan interest is an average of 5.05%. Students cannot afford such high rates. The market for private loans is monopolistically competitive. Banks like Discover and SunTrust offer different plans to pay back one's loans. Discover, for example, has repayment terms of 15 years for undergraduates and an aggregate loan limit of the school-certified tuition, while SunTrust has repayment terms of 7, 10, or 15 years and an aggregate loan limit of $150,000. Students can choose which bank they wish to take out a loan from and can compare and contrast their options, since they are all different. This allows them to face a downward-sloping demand curve and determine their own prices rather than being price takers. Banks can also mark up their interest rates above the equilibrium to maximize profit, no matter the student's ability to pay off this interest. With a price ceiling, this markup of interest rates could not legally occur. Banks would have to operate at a cap of $50,000 and would be unable to price gouge as they currently do.